Alright guys, as we've stated, the desperation levels are reaching epic proportions. The AI bubble must not collapse, not now and not ever. However, the core problem remains. Insufficient funds are available. Morgan Stanley forecasts that global data center expenditure will hit $3 trillion, with half of that capital coming from bond issues and further borrowing. The remaining half is expected to be generated from the revenue of the hyperscalers. At the center of this complicated situation is NVIDIA, the world's most valuable company, sitting amidst this circular financing instability. NVIDIA is involved in more than just designing and selling chips. Due to its substantial cash reserves, the company is able to function as a source of venture capital. They are actively investing in firms like Intel, OpenAI, and CoreWeave. It is these AI investments that are cycled back into NVIDIA. These companies then purchase more chips from CEO Jensen Huang. This explains why the entire situation depends on NVIDIA continuously developing superior chips and maintaining its continuously increasing company valuation. Nevertheless, Western markets have limitations. Even if the US and the entire G7 proceed with constructing new data centers, there will be an eventual cap on the volume of chips that can be acquired. AI chips housed in data centers possess a maximum lifespan of 2 to 5 years, meaning there will be recurring revenue, but it won't be annual and certainly not monthly. This is precisely why the US took this unexpected step. NVIDIA's past era of rapid growth, like in 2025, will not return. Last year, we observed spectacular growth rates between 100 and 300% per quarter. That period coincided with the real start of the chip war and the subsequent global rush. Furthermore, NVIDIA's competitors will not remain inactive. Intel and AMD are also preparing to launch their own chips. Consequently, the company has no viable alternative but to penetrate the Chinese market. The necessity of keeping NVIDIA solvent is critical to the entire AI competition and the chip conflict. Western markets are restricted, and China's enormous industrial base is exactly what Jensen requires. The fundamental objective of AI is to improve work processes, and manufacturing is a perpetual necessity, whether it involves producing a mobile phone, an EV, or constructing an aircraft. All of these operations can be enhanced, which requires AI, and AI is driven by these chips. Currently, China constitutes a massive $50 billion market for NVIDIA's AI chips, with growth projected at 50% annually. This rate of expansion is incredible and compounds over time. This suggests that within 4 years, the Chinese AI market alone could reach $250 billion, equivalent to $250 billion in the future. This is a primary reason why China is attempting to protect its domestic market. It also explains why Trump is urgently trying to sell US chips to Beijing. Here is a look at the extent of the desperation and how desperate his approach has become. Trump is in effect pleading with China to purchase AI accelerators from NVIDIA. However, the conditions of the arrangement are peculiar and resemble another levy on US technology firms. So here's the sequence of events. Trump authorized the sale of NVIDIA's H200 chip to China. He then contacted President Xi and announced that advanced AI chips were now available for sale, acting much like a sales representative. Naturally, the Blackwell chips and the forthcoming generation Rubin line are not included in the approved list. China itself has not made any definite commitments to purchase yet. Here's the truly strange aspect. 25% of the revenue generated by NVIDIA from the Chinese market will be directly remitted to the US government. In essence, this is a form of tax levied on US chip companies to help finance the federal deficit. This creates numerous misaligned incentives for both parties. Firstly, imposing a tax on technology companies based on revenue is questionable. NVIDIA is clearly more proficient at innovation than the US government, and the capital is better allocated if left with the company for deployment. Secondly, China now gains significant flexibility to accelerate its AI development, while simultaneously advancing its own domestic chips. Given the H200 is now permissible for import into China, we can anticipate a substantial number of Chinese AI enterprises commencing purchases. In the short term, this constitutes a victory for Chinese AI. The preceding H20 chip, which was approved for Chinese sales, had a peak processing power performance of 2,000. The current H200 is rated at 16,000, representing an 8-fold increase in performance. Of course, it is not as potent as the Blackwell series, but it is a considerable advancement over the much less powerful H20 model. Chinese domestic chips are still lagging behind. The current Huawei Ascend line represents some of China's most sophisticated domestically produced chips. Chinese corporations are connecting multiple units of these chips into clusters to simulate the performance capabilities of US accelerators. China has substantial financial resources, particularly within its technology sector. We should expect them to accumulate as many chips as possible. they will likely link the H200s together and maximize the utility of every unit of computing power. Essentially, the US AI bubble, coupled with Trump's calculated risk, is poised to provide China with a notable advantage moving forward. When combined with Chinese software modifications, we can expect further major breakthroughs similar to DeepSeek shocks to emerge in the future. Currently, China possesses only 2% of the global AI compute power, whereas the US holds a dominant 73%. But with H200 exports, China has the potential to bridge this disparity and rapidly increase its computing capability. They will have more AI resources readily available. A cautious export volume could enable China to achieve 12% of global compute power, and if NVIDIA becomes increasingly desperate and exports more, this figure could climb to 30%. The risk being undertaken by Trump and Jensen is quite considerable. Will NVIDIA generate revenue? They probably will, with billions flowing in. However, there are serious disadvantages. Chinese AI solutions may begin to rapidly surpass those in the US. When this is coupled with their open source approach, it could pose a severe problem for platforms like even ChatGPT. Global developers might increasingly rely on a Chinese AI technology stack to develop their solutions. Another potential complication is the manner in which the central government will regulate these exports. Beijing is expected to restrict access to the H200 chips. China understands the strategy. Jensen intends for Chinese companies to become dependent on NVIDIA's chip architecture, which would make decoupling significantly harder. However, China is also committed to promoting its own domestic chips. There are contenders like Huawei, Capricorn, and the latest Chinese IPO, which indicates more forthcoming competition. After that specific IPO, the company's stock value soared over 400%, which clearly underscores the seriousness of China's domestic AI chip initiative, and they will not halt their progress simply to acquire NVIDIA's chips. Therefore, China's central challenge lies in finding a delicate balance. How can they use American chips without severely impeding their indigenous technological advancement? The most effective strategy to achieve this is through controlled access, and I anticipate China might begin offering subsidies to companies that purchase domestic chips. There are also certain risks that the Chinese must take into consideration. NVIDIA's Blackwell chip still offers the US AI sector notable advantages, though by a small margin. Blackwell clusters are capable of training AI language models with greater efficiency. Specifically, they can be 50% more efficient than the H200 chips authorized for sale to China. However, China benefits from inexpensive and abundant energy, meaning their operational cost for powering their data centers is approximately 30 to 50% lower than in the US. This factor allows them to reduce operating expenditures and simultaneously enhance their overall efficiency. Let's be clear, had the US not overextended its financial capacity, they would not be willingly selling these chips to China. Beijing will definitely implement countermeasures to maximize the benefits derived from the H200 while concurrently minimizing any risk to their long-term progress. Now let's turn our attention to U.S. farming, as this industry is also experiencing extreme pressure. We are already familiar with the difficulties confronting U.S. farmers. They're facing competition from low-cost global producers. Countries like Argentina and Brazil maintain a consistently lower overall cost of production compared to U.S. farmers. The financial figures presented here predate the trade war, which has only aggravated the situation considerably. In 2023, Brazil's production cost for soybeans was $476 per acre, while the U.S. cost was nearly $530. This is a 12% cost differential, which is substantial when dealing with commodity prices. While the U.S. may benefit from less expensive fertilizers and lower financing charges, a major discrepancy arises from the land itself. Brazil has more arable land, which provides its farmers with more opportunities for growing seasons, which means more output and sales. Furthermore, since 2020, the Brazilian real has significantly weakened against the dollar, enabling their export revenues to translate into higher earnings in their domestic currency. Considering the heavy tariffs imposed on farm machinery, one can truly grasp the severity of the current predicament. Rather than addressing the fundamental, long-term structural issues, Trump chose to apply a financial solution to the problem.
I'm pleased to announce this afternoon that the United States will allocate a small portion of the hundreds of billions of dollars we collect in tariffs. We intend to be giving and providing that revenue to the farmers as economic assistance. We have great affection for our farmers, and we're using that money to furnish $12 billion in economic support to American farmers. $12 billion is a lot of money. Mel, what impact do you think this relief will have?
It will provide much-needed stability for farmers as they bring this year's harvest to market and plan for the next year's crops. Furthermore, it will support their ongoing efforts to reduce food prices for American households. Therefore, the administration is moving to implement a bailout for farmers, a $12 billion disbursement that serves more as a temporary fix than a definitive solution. U.S. farmers themselves recognize that this action merely postpones the inevitable. Trump is attempting to persuade John Deere to sell equipment at a lower cost, but even that measure is insufficient. The issue is not solely rising expenses, it also involves decreasing income. Consider soybeans, for example. In 2022, income surpassed $61 billion. Year after year, this decline has persisted, and this year U.S. farms are only projected to earn $43.5 billion. Income is plummeting. Earning less is detrimental, but when the cost of everything else is escalating, this situation becomes genuinely problematic. The cost of machinery has risen, the cost of seeds has also increased, and the cost of labor has similarly gone up. What's even more concerning is the interest expense burdening farmers. Since 2020, interest costs have surged by over 70%, which is the largest proportional increase among all major expenditures. This illustrates why U.S. interest rates must be lowered. Similar to the manufacturing sector, if costs within the